All right, welcome everybody to our Friday night wealth creation course. Thank you all for joining me. If you're tuning in on Zoom, it's great to see you all. If you're on Facebook and you're tuning in, it's good to see you all as well. We do not have Instagram up and running tonight, which is totally fine by me. But we're going to have a great conversation. We're going to be talking about investing in gold and silver, a topic I love going over. And I was just explaining to my clients here that I've not covered this in depth very much. And the reason being is I thought it was self-explanatory. I thought everyone knew gold was a good thing to own, silver was a good thing to own, tangible assets were a smart idea. But some of the stuff I see on social media made me realize that not people don't already know that this is a good idea. And so I want to go over it tonight. Now, before we dive into this, as I always cover, guys, we're covering the topic of finances and money, right? Finances and money. And so with that, it tends to be a topic that's rather complex, or at least it can seem that way. And I like to remind people that money is only math. Okay, money is only math and vocabulary. So anytime I don't understand something about finances, it comes down to there was math that I didn't get, or there was vocabulary that I didn't get. And I can look up words and I can do basic math. And if you can look up words and do basic math, you can understand anything about finances. So keep that in mind as we're going over things tonight. Now, as I usually talk about, if I say anything that does go way over your head, I want you to let me know. Okay, let me know in the comments, ask questions, ask for definitions, ask me to simplify things if you need it. There are no dumb questions. I would rather have you feel dumb for 30 seconds asking a question you think everyone else might already know the answer to than for you to be dumb for the rest of your life because you didn't ask it. So ask lots of questions. And then again, guys, as we go over this, and this is not so much of a concern with Facebook and Zoom, you guys, but obviously be positive, be constructive, be a contributor. We talk about producers and consumers. Producers add value, they give, they contribute. Consumers, they just take and they add no value. So be a producer tonight, be focused on learning and growing your finances. And then we will go over live questions. So at the end of this, if you have questions, drop them in the comments. We'll go live with you on Zoom. If you're on Facebook, we'll answer them just old school in the comments here. And guys, without further ado, I'm going to dive into our topic. We're talking about owning gold and silver. Okay, owning gold and silver. Now, what I mean by that is I mean the precious metal, like gold bullion, like the actual coin or bar, or silver bullion, the actual coin or bar. So we're not talking about collector's items. We're not talking about jewelry. We're not talking about art. We're not talking about any of that stuff. We're talking about owning investment grade gold and silver. Okay. So that's why I want to kind of clarify that is for me, I didn't know of any gold and silver other than what my parents had, which was jewelry, and they didn't have much of it. I had, my mom had a wedding ring. My dad, I don't think his ring was gold, but I'd seen it in jewelry. But when I heard about investment grade, the first thing I thought of was like, well, is that like the jewelry? And then when I started doing some research, the second thing I thought of was, okay, based on what everyone's saying, this is for conspiracy theorists, and so unless I want to wear a tinfoil hat over my head, I don't need to own gold and silver. Not true. Okay. And I want to dive into the history of gold and silver and kind of give you guys the reason why I believe it's a great asset. It's something that everyone should own. It's a great place to store and accumulate wealth, right? Now, let's dive into the history of it first. So, gold and silver, mankind discovered, as far as we know, the earliest record about 6,000 years ago. Okay, that's when we first started as a human race interacting with gold and silver, right? Initially, it was collected, it was used for jewelry. It wasn't quite used as currency yet, and so it was kind of this thing where it always had this intrinsic value. Like people discovered it, and then they automatically realized this is precious, it's beautiful, it's important, it's valuable, and they started treating it as such, right? And I like to point that out. Nobody taught people gold is used for those things. Nobody said, hey, this would make a dope ring or some earrings, right? Like we just automatically knew that. And so this is an example of what I call intrinsic value. Okay, intrinsic value, it means the innate value that something has, regardless of what others think about it. Like if you give me a brick of gold and I'm a native living out in the middle of nowhere somewhere, I'm going to see that and I'm automatically going to know this is valuable, right? A, because I've probably not seen it before, right? There's a scarcity element. But B, when I look at it, and anyone that's ever actually held physical gold, when you look at it, when you hold it, you actually can tell like there is real value here, right? So that's 6,000 years ago. Okay, now we fast forward to today and we look at, okay, well, now gold is something that we see all over the place. We may not own it, but we see it in movies. We hear about it, we read about it. We know governments own it, banks own it. It's in all the jewelry, right? It's a renowned asset class, whether you're looking at it from a collector standpoint or a jewelry standpoint, right? But how did it get there? And so if you look at with gold, it actually started to become used as a currency. Okay, so first it was kind of an art piece. It was a collector's piece. It was a jewelry piece. It started becoming used as a commodity. This was several thousand years after it was discovered. Okay, and when you start using a commodity as a currency, what you're doing is you're replacing the exchange and barter system. And so that's where gold came in. It became a uniform way to replace the exchange and barter system. People used to use corn, they used to use beans, they used to use rocks, they used to use tea, believe it or not. And so when people started using gold and silver, it was something that everyone agreed on was valuable, right? It was exchangeable, it was divisible, it was something that wasn't going to spoil or expire. It didn't have a lot of wear and tear on it, and it was recognized. And so gold started becoming used as a currency system. Okay. Now, I want you to realize before it was currency, it was valuable. This is the important factor. Before it was currency, it was valuable, right? If you go back to ancient times, you'll see kings, queens, empires, like they all collected gold before it was used as a currency, right? You look at ancient Egypt, how much gold they used on the pharaohs, their decorations, their tombs, right? Their coffins. If you look at the artwork back in the Middle East, if you read about kings, if you read about King Solomon, for example, in the Bible, apparently the wealthiest man to ever live, most of his riches were in gold. So it had intrinsic value before it was ever used as a currency. Once it became used as a currency, that's when we started looking at it as quote unquote money, right? Now, what I want to quickly do is I want to define the difference here between money and currency, right? So if we look at money and we look at currency, okay, currency is a medium of exchange. And what I mean by that is, I mean that if I'm watching, let's say my client Brad, let's say that Brad has chickens, right? And those chickens have, eggs. He can sell the chicken meat. He can do all sorts of stuff with his chickens, right? I have cows, and so this is Brad. This is Jerry, right? And let's say that Keith has wheat, right? So let's say that Brad with his chickens decides he wants some wheat, right? But Brad doesn't know Keith. Okay, Brad and Keith have no idea who each other are. Brad just knows Jerry, right? Now Jerry does know Keith, but again, Jerry doesn't know that Brad needs to know Keith. And if he did, there's some value there of being the middleman where Jerry may not want to let Brad know that he knows Keith because Keith might get bypassed. Brad might go around Jerry and go straight to Keith, right? So Brad wants wheat. Brad has chickens, right? So Brad says, Jerry, I need to get some wheat. I know you know someone that has wheat. I will trade you some of my eggs for some of your milk, and that way you have eggs, and then you can go to the wheat guy and get some of his wheat, and then you can bring it back to me. And I'll give you a couple extra eggs for you to do that. Right. And this barter system starts happening. Now, what I just explained was already a little bit complex. We only have three parties. Let's say that it turns out Keith doesn't want eggs and he doesn't want milk. Let's say Keith wants iron, right? So we might have to go over to Nano and say, Nano, you have iron. Keith wants iron, and we don't have any. So what do you want, Nano? And Nano would say, okay, well, I want milk. And I say, great, I have milk. So I will trade you milk to get you some iron. Okay. And then I'll take your iron and I'll trade it to Keith so I can get the wheat. And then I'll trade it to Brad so I can get the eggs. And I'm going to charge Brad extra eggs because I had to do this extra deal with Nano in order to be able to get the iron to get the milk or the wheat from Keith and give Brad his wheat. Okay. That was the barter system. That's very confusing, very complex, even though it's simple. It's as simple as, can I produce it and exchange it? If the answer is yes, I can barter and do business with someone. Okay, but as you can see, the more parties that are involved, the whether or not someone has a need or not in that area, whether they're interested in what I have, those are all factors that have different webs that if it's a yes or a no, it's going to send me one way or the other in order to barter for this and this and this in order to be able to exchange and get the thing that I want. So what happened was we said, okay, great, this is confusing and this is way too much work. So what we're going to do is we're going to get rid of this whole system and we're going to come up with a medium. Okay, a medium is something central that we send particles across that everyone recognizes. And so this medium is known as currency. Right? You could think about this as electricity, right? So again, we have Keith up here with his wheat. We have Jerry with his cow. Right? We've got Nano with his iron. And then we have Brad with his chickens. Instead of us going around and doing all this crazy stuff, we just say, hey, all right, Brad has chickens. It doesn't matter, you know, what he wants, what he has. As long as Brad has this currency and Keith agrees that that currency is valuable, then they can exchange, right? Now, Brad can still do business with Jerry because, again, in our previous example, Brad didn't know Keith. They were totally separated. But Brad could do business with Jerry. Jerry gives Brad currency for his eggs instead of milk for his eggs. And then Brad now has currency. Brad can go to someone that has iron and trade the currency for the iron, right? Or in the previous example, if Jerry had to do the business with Keith, Jerry could go to Keith, buy the wheat from Keith and say, hey, I've got currency. Keith would accept the currency. Jerry now has wheat. Keith now has currency. Jerry can then do business with Brad with the wheat, right? So this entire thing gets so much more simple with currency because it's a coupon system. We can redeem it and we know that it's worth something, right? So historically, currencies have all been backed by something valuable, right? They've all been backed by something valuable. And that value makes it money, right? So we look at similarities. These are both going to be a medium of exchange. Money is a medium of exchange. Currency is a medium of exchange. Okay. This is something that we can exchange with, but the difference is currency is not a store of value. And I'll explain what I mean by that in a second. Money is a store of value. Right? So the key here, and I'll give you the example of what we have today. We have US dollars today. I did a survey on Instagram a couple of months ago and I said, here's a $100 bill. Is this money or is this currency? Most people said it was money. Incorrect. It's not money. It's currency. Currency is a medium of exchange that does not have a store of value. The US dollar doesn't store value. Right now, if you save your money in dollars, you're losing about 5% of your value or more every single year. So there's not a store of value there. And so this means that this is not somewhere where we would save. So we go back to this thing, we talk about the triangle of wealth, right? We talk about earn, we talk about save, and then we talk about invest. And it's important to notate that when we earn in currency. Okay, this is simply the coupon. This is simply the transaction. This is the receipt that we can all pass back and forth to create unity, to create exchangeability, to simplify our transacting life, right? So this is currency. We do not save in currency, we just earn in currency. Our job is when we get currency, we take that currency and we save it into money. Okay? Money is going to typically be something that's a commodity, it's highly recognized, and it's actually a store of value. This is where gold and silver come in. Okay? And then once we've saved in money and we accumulate, then we invest. And then when we invest in assets. Okay, typically income producing. But those are three different things as far as actions. Okay. And then these are also three different things in terms of actual like objects, right? So when I earn in currency. When I save in money. When I invest in assets. Those are three different actions with three different objects. Where people start going wrong is where we start mixing these up. Okay, everyone earns in currency, but they think it's money. There's now a problem, right? People don't save in money, they save in currency. They've got those flipped, right? And then people invest. Most people actually don't invest, but when they do, they're investing in assets. They don't understand the assets. We're not going to talk about the investing component so much tonight. We're going to talk about the earn and the save, okay? Currency and money. So I want to kind of break this down as a preface, right? So as we're going into this, I want you thinking about this in the forefront of your head as, okay, the difference between money and currency, because there is a difference. They're not the same thing. And anyone that says they're the same thing fundamentally does not understand what money is and how money works. Okay, so let's go back to gold, right? We say 6,000 years ago or so, discovered, right? And then somewhere, about 2,000 or so years ago, more or less, this is the discovery point. We start using it as currency. And it was used as currency all the way through. Now, something happened in 1931. Sorry, in 1933. In 1933, we left the gold standard. Okay, the US government said, hey, we're going to go to a partial backed gold standard called Bretton Woods. Private citizens are no longer allowed to own gold and silver. Turn in your gold. They actually did this with silver a year later. People don't realize this. In gold, 33, they confiscated gold, and 34, they confiscated silver. They allowed silver back into the marketplace within a year or two. Gold, they actually left that outlawed until 1971. Right? So we have this incident happening where we start reducing our gold backing on our currency, because the US dollar used to be backed by gold. And then in 71, we completely leave it. So we're no longer using gold. Okay, now ironically, after 1971, private citizens were allowed to own gold again. Now today, we don't use gold for our currency, we use money. Right? The US dollar, as we refer to it, is really currency, it's not money. Right? And so people pass these papers and digits around, but the reality is those things have no real value. Okay, so what is it about gold? And what I want to point out here is, if you understand how our monetary system works, we have a couple of different entities here. We have the Federal Reserve Bank, right? We have the US Treasury, and then we have the economy. Okay, so in order for currency, for US dollars to exist, the US Treasury has to actually borrow currency from the Federal Reserve Bank, right? So there's a loan happening here. The Treasury borrows currency, US dollars, from the Federal Reserve. The Federal Reserve prints those dollars and basically pulls them out of thin air because they don't actually exist, give it to the US Treasury. The US Treasury then disperses it into the economy through war, public works, jobs, etc. And it goes out, whether that be stimulus checks, it can be anything really, but it gets into the economy that way. Okay, so when this happens, I want you to understand where the currency originates from. It originates from the Federal Reserve Bank, which is not federal, it's not a reserve, and it's not a bank. Okay, the Federal Reserve Bank primarily owns two things: US debt and gold. Okay, US debt and gold. Now, when we look at this, I want you to look at a quote as well, and I'm gonna kind of paraphrase it. You can look this up. This was back in the early 1900s. J.P. Morgan, the founder of J.P. Morgan Chase Bank, at the back in the time it was just J.P. Morgan. They merged with Chase several years ago, but J.P. Morgan has a quote, and he's often misquoted, where he says, "Gold is money, everything else is credit." He actually never said that. It's not a quote from J.P. Morgan. That's misquoted. What he said is, he said, if a borrower has paper currency and a bank has gold, he says the bank is better off than the borrower, and the borrower and his customers are all worse off than the bank. So he's saying that the bank owns gold because it makes them better off than the borrower. The Federal Reserve Bank is no different. They own the most gold, so they're the number one buyer and number one owner of gold, right? And when we talk about how much, we're going to get into numbers here, but I want you to realize they issue currency, they pass out dollars, they give us paper and digits, paper and digits, paper and digits. Yet they don't own paper and digits. They own gold. That's their primary asset. Okay, That and US debt. They want the United States government in debt to them, paying them interest. They want our taxpayer dollars going to cover interest, right? Because that gives them ability to have control and power over our earnings, right? It's a form of financial slavery. They like being the slave master. They always have, they always will. Yet they don't want to own any of the stuff that they tell us to own. They want to own gold. And the reason why is they understand gold has real value. Empires are built on gold, and those that have the gold have the power. And so if you look at this, the Federal Reserve Bank, the central bank in the United States, that's their primary asset. Okay, so I want to dive into how much gold they have. Okay, and I pulled this up. I'm going to go over this with you guys here on my screen share because there's actually a list of the top bank holdings. So if you look at top central bank holdings for gold, we're going to go over that together real quick. Okay, so this is top holdings for the top 10 central banks in gold. So the global central bank reserves, they have 33,000 tons. Okay, so they own roughly 1/5 of all gold ever mined. Okay, now I want you to understand, like, there's the light and fluffy, idealistic, patriotic, like we vote and have politicians and presidents and everyone's got free will. That's great. It's not real. Okay. The central banks, they run and control everything. They finance the wars, they finance the diseases, they finance the famines, they finance the poverty, they finance the racism. Every single thing that we have wrong in our country is financed by the central banks. Okay, I am of the opinion that the president doesn't even have a say. I think he works for them. I think he's the puppet. Doesn't matter which side. I think that it's just a game, and that guy is the one that they put out for the PR figure. That's off on a different bunny trail. But my point is that these are the guys that really run and control the world. If you look and study history, you understand what happened in 1913, and you understand what happened prior to 1913, and how many attempts there were at putting a central bank in the United States of America, right? And you look at how many central banks were spread out through Europe, England. You can look at the Rockefellers, you can look at the Rothschilds, you can look at J.P. Morgan. Like, these guys ran the world. Okay, AT&T used to be Bell Corporation. AT&T was funded by J.P. Morgan. Okay, General Electric was funded by J.P. Morgan. That was Thomas Edison. He put Tesla out of business via JP Morgan. JP Morgan funded that company. Like, you can look at all this stuff and it's totally financed by central banks. So what I'm telling you is the government issues currency for us to all work for and spend and save. And the reason why is there has to be a carrot. There has to be something that we're all going after, right? So that gets us working and producing, because a government can't have an economy if there aren't citizens producing, right? So we're all squabbling around for paper dollars and digits. Secondarily, we then save in this currency. We've been convinced not to save in gold and silver. What happens when we save in the currency? The currency value goes down. It doesn't buy as much. So we think our savings accounts are still beefed up. They're not. They're going down in value. So then we have to go work harder. But the thing is next year when we work, the money's worth even less. So we're working for less and less value and saving less and less value and working harder and harder and harder and harder and harder over and over and over and over, while the central banks own the assets and they issue the currency. Okay, so check this out. Top 10 holdings. First is the United States. Okay, the United States owns 8,133.5 tons. Okay, tons, these are metric tons. This comes out to, as it says here in the US dollar, valued at $10.9 billion, right? So let me ask you this. If gold is a relic and it's a dying asset and nobody should own it, why does the company, I'm going to call it the company because it is a company, why does the private corporation that runs the United States government own more gold than any other entity in the world? Why is that? Right? We have to look at stats. They don't own Bitcoin. They don't own currency. They own gold. They don't even own real estate. Right? So we have to really study this to understand, okay, there are things called statistics. Statistics are representations of actions. And if we look at the statistic, this is a really big statistic saying that the country or the company that basically runs the country, and you could argue the world, right? They own more gold than anybody else, and they're the number one buyer of it. Okay, we look at the next one, Germany, 3,362.4 tons. Italy, look how far off these numbers are. Italy, 2,451 tons. France, 2,436. We have, guys, we have over 8,000. Look at the difference in these numbers. 8,133, and the closest is Germany with 3,362. So when I look at building wealth, I'm looking at what are the wealthiest people in the world do. There's a quote from one of the Rockefellers. I forget his first name. One of the Rockefellers. You can look up which one says the key to wealth is own nothing and control everything. Own nothing and control everything. A central bank is the definition of own nothing, control everything. Okay, but they do own gold, right? So when we look at gold, we have to look at a couple of things here. The reason why I like to save in gold is not just because the central banks do it. That's a good indicator. Like, I look at the wealthiest people in the world, and I want to break this down. If you look at the Rothschilds, for example, largest banking dynasty in history, right? The Rothschild family, they spread out. They started in England, and then they spread out through France, and they spread out through Germany, and they spread out through all over the European world, and then they got into the United States via J.P. Morgan. Okay, so the Rothschilds disappeared. If you look at the Forbes list, they are not on the Forbes list. There's one of them, David Rothschild. He's only worth like $3 or $4 billion. Okay, how does the largest banking dynasty in the history of the world just disappear? Right? So this quote of own nothing, yet control everything. This is one of the things they did. They didn't want to own anything. They wanted to control it all. If you look at JP Morgan, another banker, when he died, and they presented his personal net worth, it was like $110 million, I want to say. And John Rockefeller actually made the comment that he was surprised that JP Morgan was worth so little. But I want you to look at whose name is still around. Okay, and I'm not talking about like Rockefeller Center and the Christmas tree. I'm saying whose company still exists. Rockefeller doesn't. Standard Oil was broken apart. JP Morgan exists still. Own nothing, control everything, right? So this is one of the first phases that these bankers would go through. The second phase would be the disappearing act, right? You look at some of the most powerful forces in the universe and nature, you can't see them. You can't see them, yet they're there, right? The wind, you can't see it, but it's there, right? Oxygen, you can't see it, but it's there. God, you can't see him, but he's there. So somebody can disappear, but still be there. That's a mighty powerful thing to be able to do. Okay. Now, one of the only ways to do that with assets is by owning gold, right? I can't disappear and still own real estate because people will say, oh, the real estate's owned by this group. And so I can track that and see it, right? And so that's something that's important to realize. So if I own assets that can be tracked, it makes it very hard for me to disappear and be invisible. It also makes me very hard to own nothing because I've got to own some of this stuff. So I can own gold. That's something I can disappear with, and I can still have value, and I can still have assets, and I can still have power without anyone knowing about it because the gold, it's private ownership. No one tracks it, right? So this is one of the factors that I like about it. Now, the other thing that I appreciate about gold is if we chart gold, and silver is very similar. If we chart them from 1971 until now, the growth projection that we see on gold is about an 8% compounding annual growth rate. Okay. And that's based on price, not value, right? So again, with assets, they're going to be measured on either history, like track record, they're going to be measured on earnings, they're going to be measured on intrinsic value, or they're going to be measured on extrinsic value, right? Gold checks off three of those boxes. It's got a track record, it's got intrinsic value, it's got extrinsic value. It does not have earnings. It's something that goes up and down in price. So gold has about an 8% compounding annual growth rate since it's been made legal again. And it also has a standard deviation of about 15%. Okay, so what that means is if I own gold, it's going to, on an average year, do an 8% growth, but from that 8% benchmark, it can go up 15%, and it can also go down 15%. This is, again, historical averages. So for me, what I like to do with my gold is I like to borrow against it. I like to collateralize it, right? Because what I said was we save money in gold. We do not invest in gold. We store our value in gold. right? Gold doesn't produce income. One of the first things that we go for is we go for passive income that exceeds our savings, expenses, and taxes. Gold doesn't achieve that because it does not produce an income, right? So what do we do instead? We save money in gold. That gold goes up in value, right? So we know that it's going to go up on average by about 8%. It can be more, it could be less. It's going to kind of look like this, right? With an upward trend of about 8%. But if I collateralize it, what I can do here is I can borrow against it just like I can life insurance, right? So I have my gold. My gold is growing at +8 on average. I can borrow usually about 75% of the value of my gold, and I'm going to pay usually a 1 to 3% interest cost to do this. And so now I have, let's say that I had 100 grand in gold growing at 8%. I've now just borrowed 75K that costs me 1 to 3. This 75K I can then go invest in real estate and I can earn 8 to 12%, right? So this actually helps me complete the triangle of wealth. We talk about earn, we talk about save, we talk about invest. I earn in currency, I take the currency, I exchange it for money, and then I take the money and I convert it into assets. The assets produce more currency and it feeds itself and cycles over and over and over. Now, in this model, I'm still, when I borrow against my gold, I'm still making the 8% on it, right? So I accumulate, I save in gold, I save in silver. Silver is about the same. If you look at it from about 1971 or so, it's still about an 8% annual growth rate. The difference on silver is it's a lot more volatile. So silver has a standard deviation of about 25%, which again means if it does +8 on average, that means any given year it can go 25% above that, or it can go 25% below that, right? So I don't do as much with silver because of the up and down. I don't want to collateralize it and then have my loans go down in loan to value ratio, and I have a margin call, and then I've got to pay it off. But I do like it with gold because I can control a 15% standard deviation, right? I'm only borrowing 75%, which means I've got 25% equity the entire time. I'm always safe. Okay, and then I keep a 10% reserve off to the side. But here I'm making 8, and let's say I'm making 12. Guys, that's a 20% return. If I take out my fees, let's say 2 on average, right? On my interest cost, which I'm also going to write this off on my taxes, by the way, this is a positive 18% return on real assets. Okay, we're not talking about digits and paper. We're talking about physical gold, and we're talking about physical real estate. I can touch the gold. I can go knock on the door of the real estate, right? So I can make 20% a year doing this. And this is not complicated. It's not complex. There's no like, it fits everything we're looking for. I like it. I understand it. It fits me as an investor. It fits my goals as an investor. It's got track record. It's got earnings. It's got intrinsic value, and it's got extrinsic value. Every single box is checked here. There's no other way to do this. Well, you still check every single box. And I want you to realize each time you leave one of those boxes unchecked, you're leaving risk in the equation that doesn't need to be there. When I invest in something or I put my money into something that has no track record, I'm adding risk. When I put money into something that has no earnings, I'm adding risk. When I put money into something that's got no intrinsic value, I'm adding risk. Put it into something with no extrinsic value, that's added risk. If I don't like it, that's added risk. If I don't understand it, that's added risk. Right? If it doesn't fit me, that's added risk. If it doesn't fit my goals, that's added risk. Okay, so this is what I like to do with gold. Now, one of the things that I want to go over on this is, again, we talked about central banks own about 1/5, right? 1/5 of all the gold in the world. It's about 20%, right? Now, only about 12% is owned by the public in the United States, right? So if you look at the difference here, I think 12 is the right number. If you look at the central banks, they own 20%, and then only about 12% of people own any gold. So this is not 12% of gold. This is 12% of people, right? This 20% is of gold, right? So all of the central banks own gold, comes out to a number of about 20%. Only about 12% of people own any gold. Now, I want you to realize prior to 1931, this number was 100%. We used to all own gold because your dollar was actually a deposit slip. You could take your dollar to the treasury or to the bank and you could actually turn it in and you could get its value in gold. Right. So if it said, if it said it's worth, one gold American Eagle, right? For example, you could go get a gold American Eagle by having a dollar, you owned the right to then get real gold. You no longer own that right inherently in your dollar. And so the only way to own gold is to physically have it in investment grade bullion or jewelry or something of that sort. Only 12% of people own any at all. Okay. Now here's what I want to point out. There's only enough gold in existence for on this planet 100% of people, right? So that's I think 7.7 billion, right? So let's say that's the number. Could be a little more than that now to own 1 ounce. Think about that. There's only enough gold for 1 ounce to go around. Okay, you can't mine gold. I want you to realize where gold comes from. Gold comes from something called a supernova, which is when a star explodes. So it literally comes from outer space. We can't like the manufacturing process. They try to artificially make gold here on Earth. The process involves very high levels of radioactivity, and it was so financially expensive that it actually wasn't worth doing. Right? So gold is not something that can be manufactured. It's not something that can be created. You literally have to have a star explode in freaking outer space in order for gold to be produced. There's no more than what's there. And so there's only enough there for each of us to have 1 ounce. Silver is about 8 ounces, right? So silver is about 8 ounces each. What's there is there, right? We're talking about physical gold. We're not talking about derivatives, contracts, or any of that bullshit. That's just paper and digits. We're talking about for me to own a physical bar of gold, I can only own 1 ounce if I give one to everyone around in the world. Silver, I can only own 8 ounces if I give one to everyone in the world. Right? You can't create more of it. You can't duplicate it. You can't copy it. Now, silver is interesting. Silver is actually a byproduct of gold mining. So when you mine gold and you purify it, silver is actually a material that comes out of that process. Similar to, for those of you that are into working out whey protein is actually a product of going through the process of creating milk. You get whey and casein, and those are things that come out of it. So you can only get as much silver as you can get gold, because you can only get silver by mining and purifying gold and going through that process. Right? So we talk about intrinsic value, like intrinsic value means that it's worth something. And then we talk about extrinsic value. That's where other people realize it's worth something. That's where there's the scarcity of it. There's got to be some sort of scarcity that can be, placed on it, where someone say, hey, this item is more valuable in relation to other things because less of it exists. Right? Dollars, they print them every day. There's no shortage of dollars. So you don't save in dollars because there's no scarcity. And I've talked about this before. It's like if my water was filled with Kool-Aid, right? And I start pouring water in the Kool-Aid, it's going to dilute the value or the power of the Kool-Aid that's in the glass, because I'm adding in water and diluting it. And eventually it's not going to be Kool-Aid anymore. Eventually there's going to be more water than there is solution. And if I keep going, there's going to be almost no solution. And that's where we are with the dollar right now. So saving in currency is a major mistake. Right? Now, if I look at saving in gold, like, sure, I'm not going to go out and pay for my groceries with it, but I'm saying you're going to store value. You're not buying and selling things with it. That's what currency is for. I don't care if the currency is digits, dollars, crypto. Like, there's going to be so many different currencies. There already has been so many. They're all worthless. They don't mean anything. When you get the currency, how do you transact it into something valuable that maintains and stores the value, that's tangible, that you can actually see and hold and touch and keep with you, and then turn into real assets? That's the name of the game here. Okay. So this is kind of like looking at the scarcity of it, how it's created. And when I learned this, I realized, okay, the banks already own 20% of it. All the gold in the world, average people only own 12. At the time, I owned none. Okay, now we also have to realize the average person also owns no currency. If you look at the average American, I think 60% of Americans have less than $1,000 saved. Okay, so there's something to be said for, we have to be able to earn income and get the currency, and then keep enough of the currency so that we can buy money or commodities or gold or whatever it is we're buying, and then exchange that for the assets. But it does still start with earning income, which is typically going to be in some form of currency. Okay, so guys, this is really important to understand. Now, how do we go about buying gold, right? So again, when you're buying gold, you want to buy investment grade. Okay, so when you're buying investment grade. You're not looking for jewelry. You're not looking for collectibles. You're not looking for what they call numismatic, which is where they'll say this really special looking coin with this really special person on it, that was minted only, limited number of coins, is worth more than its ounce weight, or whatever the value would be measured in, just the raw value of it, because of the special little collector's item or person or logo or mint that it came from. We don't want that. We want investment grade. It's called bullion, right? You're typically going to be buying bars and coins. I should say rounds, because coins typically indicate that there are going to be premiums for whatever you're buying from. By the way, little trick here. American Eagles are not a good thing to buy. I know everyone thinks they are. They're not actually pure gold. I think they're only 90%, right, Lexi? American Eagles? 92%, right? So when I'm buying gold, I'm not buying silver Eagles and I'm not buying American Eagles. I'm buying generic bars and I'm buying generic rounds. Okay, you can buy them, but you're not getting anything special. You're actually overpaying for less value. So we're buying bars and rounds. And then the denomination is important too. Right, so I can buy 1 gram, I can buy 5 grams, I can buy 1/10 of an ounce, I can buy, half an ounce, 1 ounce, 10 ounces, 100 ounces. I can buy kilos, right? These are all denominations. These are the actual weight or the actual size of the bullion that I'm buying. When I'm buying, I want to go higher denomination. Okay, so the higher denomination actually reduces the price, right? So when I pay for gold, and again, there's a difference between price and value. So gold is traded on something called the COMEX, the Chicago Mercantile Exchange. That is not the value of gold, that is the price of gold. Okay, when you see stock prices, when you see gold prices, you see cryptocurrency prices, those are not the value of those assets, those are the prices. That means that's what someone would pay on the market. Just like anything, you can underpay and you can overpay based on what the actual value of the thing is. So when I buy 1 gram of gold, for example, I'm going to pay a higher premium because it takes more manpower and it's more expensive to manufacture 1 gram of gold. It's smaller, there's more work that goes into chopping and cutting it and making sure that it's, the right size and everything, and it's more detail oriented than if I buy a kilo, which is literally a 32-ounce brick. 32-ounce brick, the production costs are lower, and because of that, I can buy it for a cheaper markup. So really pay attention to the denominations. Now, when I first started, I was buying 1 gram and 5 grams because I couldn't afford the 1 ounces and the 10 ounces. Now I buy mostly kilos and 100 ounces at a time. Okay, because I'm really looking at, okay, what's my premium? Now, again, the premium you might pay, 5 to 20%, depending on what you're buying. You could pay on this end of things 3% or less, depending on what you're buying. Okay, but I want you to look at, okay, what is the denomination? How can I buy bigger? And you'll hear people say like don't buy gold because you can't pay your groceries with it. Like that's so stupid. You're not going to do that with gold anyways. You're going to buy assets with it. So if you buy a kilo, you're going to borrow against the kilo. You're going to put that into the real estate like we mentioned. This is not grocery money. That's actually called poverty mindset. Okay. So the grocery money, that's your currency. You keep that in currency because that's what people accept. Most people wouldn't accept your gold in the first place because only 12% own it, because only 12% are smart enough to understand how valuable it is, which means 88% of Americans are too dumb to know that gold is better than paper anyways. They wouldn't want it in the first place. You can go to the grocery store and they would look at you and be like, what's that? Okay. So the denomination is important. And then again, the other one is time frame. This is not something we trade with. And I don't know why. I think it might be the whole Forex market, but the average person I talk to has it in their head that when you buy gold, the entire point of it is to trade. It's not. You want to hold it for 5 years or more. Right? 5 years or more. If you can't hold it for 5 years or more, don't buy it at all. Okay, if you're going to trade it, buy an ETF or buy a futures contract, because when you buy physical gold, again, you're paying a markup, which means that it's costing you more. So if I buy it now and my goal is to trade it and I pay a 3% premium, that means that in the short term, I have to make 3% plus in order to actually break even on the gold. Okay, so the shorter the time frame, the more risk is involved. With investing, the shorter the time frame, the more risk is involved in the transaction. The longer the time frame, the less risk is involved. So when I try and trade it, I'm actually adding risk to this. And then I'm also adding risk because I have to break even higher than my break even just to get my premiums back. Okay, so the time frame, you want to look at 5 years or more. Okay, now also when you're buying, you obviously want to make sure that it's genuine. So you want to buy from reputable dealers and brokers. You don't want to buy from pawn shops. You don't want to buy from Craigslist. You don't want to buy from estate sales unless you actually have the tools to verify the purity levels of the gold, right? So you want to buy from reputable dealers and brokers that work with wholesalers and mints that produce and have, a good reputation in the bullion industry of selling good products. Okay, because people will strip out the middle of gold, for example, they'll fill it with tungsten and then they'll repaint it and melt back over it. You can't tell the difference until you take it to an appraiser and they shoot it with their little x-ray gun and find out that it's tungsten. And then you paid, $2,000 for 1 ounce of tungsten, which is worth nothing remotely close to that. Okay. Now, the other thing too is when you're buying from different dealers, just like with anything, you're going to see typically, I would say, like big box, and then you're going to see like specialty. Okay. Wealth Dynamics, my company, we're what would be known as like a specialty. It's a one-on-one relationship, right? Like you have a gold broker. I am your guy. I lock in your transactions with my team. We take care of you. You service you, right? If you go to, for example, like a JM Bullion, they'll beat us on price almost every time, but they also will sell your information. And they don't tell you they will sell your information. The reason why these big box guys can sell at such a low price is because you are the product. Their product is not gold, you are the product. And what I mean by that is, number one, they sell your information to third-party marketers for a commission or a brokerage fee, and they make money on your personal data so that these companies can use you for marketing and demographics, right? The other thing that they do is they sell your information to hedge funds who actually short your purchases. Okay, someone in the comments is talking about how gold and silver prices are manipulated. That is true. So when you buy from these big box dealers, they sell your information to hedge funds. The hedge funds look at your positions and then they bet against you. And the reason that they bet against you is the same reason they bet against GameStop, right? They know that they can bet the price down and make money on it because they have enough volume to move the markets. Okay, it's super dirty and they don't tell you they do it, but that's what they do, and they make big money to do it. They almost don't need to be selling gold. They just need your information, but they know that they can get your information by selling gold. Right? So understand who you're doing business with. Specialty like Wealth Dynamics, we don't do any of that. So it's private. We don't report your information. We don't sell it. We don't give it to hedge funds. If we don't have to give it to the government or anything, we don't do that either. Sometimes we have to report sales tax. If we don't, we don't. Like, for example, certain states you buy in are taxable based on sales tax or collector's tax. Certain states aren't. So, for example, we've set up our depositories in states where they don't have that because we don't want to have to report anybody's information to anybody, right? So we keep it private. These are all things on the how side of owning gold. Okay, so again, make it investment grade, make sure that it's bullion, bars, and rounds. The higher the denomination, better. The longer the time frame, the better, right? You want to make sure that you're working with reputable dealers and brokers. You want to work with specialty, not big box, unless you want to have your purchases shorted and your information sold. Okay, now, again, this is something where if we look at this triangle of wealth of earn, save, invest, let's go back to denomination real quick. The denomination that I buy, whether it's a 1 gram or a 1 ounce or a 100 ounce, is going to be based on my earning power. The more currency that I can earn, the more money that I'm going to be able to store my currency or my value in. And I'm going to be able to do it in higher denominations. So what I want to encourage you on is start with something, because currency is a bad idea. Saving money in currency is a terrible idea. Literally, like, there's nothing good about it. There's literally nothing good about it. You can say it's exchangeable. So is gold. I can sell it on the open market like that, right? You can say that you can move it around in denominations. You can do that too. If I have 100 ounces, I can go to a dealer and say, hey, give me 100 ounces worth of gold and 5 gram bars instead. I can do that, right? All of the things that I can say about currency, I can say about gold. The only difference is the currency goes down in value every year that I hold it. The gold doesn't. It goes up in value, right? So I can look at these different denominations and I can say, well, I should wait till I can buy 100 ounces because it's going to be cheaper, right? But the opportunity cost is I'm holding currency and losing money anyways. So the longer that I keep the currency, the less value I have. So when I finally do go to buy the gold, the price of the gold has gone up and the value of the currency has gone down, and I have a gigantic negative spread. So what I'm saying is start with something, even if it is 1 gram, even if it has to be a half an ounce or whatever that tiny little number is, it's something, and it actually trains you. And this is the other thing that I like about gold and silver. I'm going to hit a couple more points here before I wrap up, is it teaches you to hold an investment, right? It's tangible, right? So we have this problem in today's investing culture of chasing returns and buying invisible objects and essentially speculating and hoping we can get rich on nonsense. Gold and silver, like, you buy a thing, it's real, you can see it, you can count it, and because it's real, it's that much harder for you to do something stupid with. Okay, we actually have emotional receptors in our brains that when we lose something of physical value, it creates an emotional loss for us. It's the reason why when you spend on a credit card, it's so much easier than cash. Because when you swipe it, you don't think about it. It's not something that's leaving, it's just an action. Versus when you have to give up money, then you're like, oh crap, there's $100 in my hand, I'm getting rid of it. It's actually a physical moment. Okay, that can't happen with digits and transactions online. So this teaches you to buy something that's real, and it teaches you to hold it, and it teaches you to hold it until you're at the point of investing it for something smart. Which, again, the point of this is to buy it and hold and then borrow against and invest for passive income. So until I've got enough to invest for passive income, I'm holding it and I'm sitting on it. And that behavior is what makes a good investor. It's like cooking a good steak. Who's ever cooked a steak or seen someone cook a steak where they're always poking it and flipping it and touching it, right? Anyone that's a good barbecue grill guy or a good steak or cook or even on a pan knows that you put the steak down and then you leave it the hell alone. You don't touch it, you don't prod it, you don't pick at it. You leave it there for 4, 5, 6, 7 minutes. It's gonna brown, it's gonna crisp, and then you flip it once, and then you leave it on that side for another 4, 5, 6, 7 minutes, and you don't touch it again. Okay, an experienced cook knows that. A novice, they're freaking jabbing at it and touching it, and they're flipping it over and flipping it over. All you're doing is killing it. It's gonna taste terrible when you're done. Right? Investing is no different. The ability to buy something smart, hold it until I'm ready for its intended use is a skill. Skills can't be purchased. Skills are behaviors, right? There's no financial instrument that replaces behavior. So my ability to demonstrate smart financial behavior is the easiest to demonstrate with bullion, with gold and silver. Okay, and this means I'm not trading it. This means that I'm not, like, moving money in and out of it. It means that I am buying it and holding it, and it's going up in value by 8% a year, and I'm going to use that to borrow against and then put it into a deal. And that's it. It's that simple, right? This investing thing is about scale. It's not this active, change everything, move everything. It's about scaling something that already works. My income and my ability to save are the things I'm scaling. The investment is not the thing I'm scaling. The investment scales the prior two things, right? So, guys, I want to open this up for some questions. And actually, really quick, I hit this before, but I want to hit this one more time. The difference between price and value. Okay, that's the other thing to realize. With gold, you have to really understand the value behind it. You can see that on usdebtclock.org. If you look at the amount of dollars in circulation compared to the ounce of gold back then in 1913 versus today, you can also look at current currency units per person and then divide that price by gold. Okay, that shows you like actual values of gold, because when you look at the Chicago Mercantile Exchange, the COMEX markets, that's price, that's not value. Okay, I can show you freaking Dogecoin, right? Literally worthless. But people are making buku money because the price goes up, but it has no value. So you have to really understand the difference between those two things. So what I want to do is I'm going to open this up for some questions. I know we covered a lot tonight. This is a pretty broad topic. I want to really make sure that people are understanding it and getting everything they can out of it, because this is something that should translate to behavior. Let's see if we have any questions here on Facebook first. All right, I do not see any questions on Facebook. Good, so let's check Zoom first. So if you're on Zoom and you drop the question, we can go ahead and answer those live here tonight. All right, let's see what we have in the chat here. Good to see everybody. Thank you guys all for the questions. Keith, good to see you. Nicholas C says, not to be rude, but cryptocurrency does all, it doesn't actually. The bottom line on cryptocurrency, and I'm not going to get into a cryptocurrency debate, it isn't anything, right? If you read the parable, The Emperor's New Clothes, that is cryptocurrency. There's no anything there. It's literally a computer code, right? It's not a currency because we can't transact with it. It's expensive, and at this point, it's so volatile that most people that have it are holding it because they think it's going to go up. So it's not actually being used as a currency, right? If you look at the other argument, which is it's a store of value, it's not storing any value. It's storing your currency value. It's storing digital numbers on more digital numbers. So there's not actually value being stored. In order for me to store value, it'd have to be a transference into something that actually has intrinsic value. Okay, cryptocurrency has extrinsic value, and that's it. It's got, so we talk about track record, earnings, intrinsic value, extrinsic value. At this point, it does have a track record. If you look at Bitcoin, it has 10 years. It does not have earnings. Okay, it doesn't have intrinsic value. It does have extrinsic value. So it's only got 2 of the 4. For me, it's got to have at least 3. So in my opinion, at this point, it falls more into the collector's item category. It's got extrinsic value. Lots of people think it might be worth something. There's a scarcity around it. It's kind of like a digital baseball card. Like a lot of the stuff that's coming out, like the NFTs, is literally like that. And so there's a big difference between that and physical gold. And again, you have to look at who owns it. If you look at central banks, they're not owning cryptocurrency, they're owning physical bullion. Let's see. Okay, so Nano says that quote is from John D. Rockefeller, own nothing, control everything. Okay, we have a question here from Keith Keller. Let me go ahead and bring Keith on live here and answer his question. All right, we have Keith live with us. How are you tonight, Keith?
Very good, Jerry. How about yourself?
I'm good. Thanks for asking. It's good to talk to you.
Yeah, I actually had a couple of comments and then a question. So the comments, first, really enjoyed the illustration of barter. And just as a, trivia, my grandfather, wheat farmer in Kansas. So spot on, man.
Okay, we were right on point with that then. That's totally coincidence.
Pretty funny. So my question, you talked about owning, physical gold and using that as, leverage for investing. How do you verify, or, what's the process to validate that you have, X amount of gold and the value of that? And then how do you, get a loan against that if it's, something like you say is under your bed?
Yeah, so that's a good question. So Keith is asking, when you get enough money where you're ready to borrow against the gold. Now, to borrow against it, you're posting it as collateral. So I'm going to a bullion bank and I'm saying, hey, I've got 50 grand worth of gold or 100 grand worth of gold. I want to borrow against it and take a loan. At that point, I am actually sending it to them as collateral. So it's not going to be under my bed anymore. I'm going to send it to them. They're going to physically verify it. So they're going to make sure that it's pure, it's real. They're going to base it off of the spot price on the COMEX market. And then they'll extend to me a line of credit. And then typically that process might take a week or two of them underwriting it, checking my credit, et cetera. And then once I've like completed that process, they'll wire me the funds within 2 or 3 business days. So that's how that looks. And then for amounts, typically you need around 15,000 minimum to start. And again, at a 75% loan to value, if you own 15, you probably are borrowing around 12, right? Your interest rates are usually going to be about 5 to 6% interest only. That's your gross rate. So very similar to life insurance. And just like the life insurance, when we borrow against it, we're investing it for passive income. We're taking that passive income and we're paying our line of credit back. So by doing so, we're reducing the principal and thereby also reducing the total interest costs. And then we're taking that net interest cost and writing that off on our taxes as an investment expense. And so that's where we get that 1 to 3% actual cost is the net cost after tax write-off. So very good question, Keith. All right, we have a question here from Jennifer. Let me go ahead and bring Jennifer on live here. All right, we have Jennifer live tonight. How are you tonight, Jennifer?
I'm doing well. How are you, Jerry?
I'm good. Thanks for asking. So what is your question?
It was similar to the last one regarding how do you borrow against the gold, but for my case, I was asking about if I've purchased gold in a self-directed IRA, is it possible to do that leveraging?
I see. So that's actually with self-directed IRAs, one of the only times you cannot borrow against gold. Self-directed IRAs are not allowed to have debt in them. And if they do, you pay UDFI, unrelated debt financing interest or interest tax on it, or unrelated debt financing income tax, I believe is what that stands for. UDFI, which is about 40% of any income generated by the debt. So it's not something you would do in a self-directed IRA. So it's basically going to be non-qualified money, which is just cash that you put into gold, not inside a retirement account. And if it's in a retirement account, it basically just sits there and it'll appreciate over time. With that, the game is going to be it appreciates at a certain price you sell, and then you put that into something else, whether that's real estate or whatever it may be. And the benefit there still would be if you're selling, you're avoiding capital gains because it's in an IRA. So there's still some good benefit to owning that there. All right, let's see here. Nano says he's the barbecue guy. I can vouch for that. Nano is excellent on the grill. All right, we have a question here from Avery. Let me go ahead and bring Avery on live here. All right, how's it going, Avery?
What's up, Jerry?
I'm good. I'm good. Thanks for asking. How can I help out tonight?
Yeah, you know what? Keith actually beat me to it. I can imagine all of us were probably a little curious about that, and probably either Wealth Dynamics probably owns the bullion bank, or you probably have a relationship outside of that in order for us to use the gold as collateral.
That's true. Yeah. So we have a couple of banks in mind that we work with. I work with personally on my own deals, and then we work with exclusively on clients. So there aren't a ton of them. And then you've got to make sure you're not working with the equivalent of like a pawn shop. There are certain ones where you call them and they're like, totally, we'll give you a loan. And it's 25% interest. And so you want to stay away from that. A good bullion bank is going to give you, like I said, a 4, 5, 6% gross rate. And then by working our strategy, you can really get that spread if you're earning 8 and paying a 1 to 3% net. And then we'll connect you with the right people to do that. All right, we have a question here from Brad here. Let me bring Brad on live. All right, we have Brad Reese from Minnesota. How are you tonight, Brad?
Good, Jerry. How are you in Florida there?
I am loving it. It's super warm. It hasn't reached summertime hot yet, so I don't know what's going to happen then. But right now, it's great.
Very cool. Very cool. Yeah, my question is, well, I have a couple, but this one is, why is gold not promoted as an investment? You know, the CRG is CAR, I'm sorry, CAGR is, you know, compound annual growth rate is at 8%, just like they promote it in the stock market. You know, say well, you can make an 8% return. They don't talk about fees or anything when the net comes out. What do you think that is? They just don't want that to be known?
Yeah, that's a really good question. So there are a couple of reasons. The main one being when you buy gold, the majority of the money is actually going into something, right? So I'm buying gold. The majority of the currency that I'm using goes to purchasing a physical bar of gold. When I buy a stock, the money doesn't actually go anywhere, right? It goes into the pockets of the company that issued the stock or that's selling the stock. And so there's a lot more leeway for them to be able to spend and basically it's almost like the bookkeeping side of things. There's a lot of flexibility and almost underhandedness that they can do with the finance once it comes in on stock transactions, because they don't actually have to produce or give me anything valuable. They just say, yeah, you own a share, right? Versus with gold, if I gave them 60 grand, the majority of the 60 grand does have to go towards furnishing the physical value of the gold. It can't just go in their pockets and then I get an invisible share and a piece of paper that says congratulations. So that's the big reason there's not transparency, or there's a lot of transparency with gold as well. Wall Street does not like transparency, so there's a lot less room for manipulation. And you can even see that if you buy mutual funds, you can buy mutual funds that invest in gold indexes, but you can't buy gold from Wall Street. And the reason again is the gold itself provides too much transparency. It's too expensive. They don't get to keep enough money and they have to actually like buck up and produce something for you. So those are a couple of the top reasons among many. Let's see, we have a question here from Brandon. Let me go ahead and bring Brandon on live here. He's got a question. Excellent questions from everyone tonight. Let's see, this is Brandon Metz. Let me go ahead and bring Brandon on. All right, we have Brandon live. How are you tonight?
How you doing, man? First of all, I just want to say this whole thing is life-changing for me. It's very awakening, and I'm very grateful that you're sharing this information with us.
Absolutely. It's great to have you on. What's your question?
So my question is, which stores, like in Miami, for example, they're accepting cryptocurrency, that still holds no value in the future, you think?
That's a good question. So with cryptocurrency, it is starting to be used a little bit more and more. We're seeing like PayPal and some of these other companies accepting them. Brandon's in Miami, so some of these bigger areas are accepting it. So some of them are accepting something called stablecoin, which is connected or tied to the US dollar. And so there's not a lot of volatility there. The risk with a cryptocurrency is, let's say that Brandon sells produce and he's selling produce for, you know, $5 a pound. And so I pay for it in Bitcoin. At the time of the transaction closing, I give him $5 worth of Bitcoin, but then the crypto market tanks 50% in value. And so by the time Brandon gets my money, he only has $2.50 worth of Bitcoin instead of $5 worth of Bitcoin. And so it puts a lot of risk on Brandon. And then also right now, the way that Bitcoin and these cryptocurrencies are taxed, when I sell it, there is a capital gains tax. So if I sell it at a gain, like I pay for something and I pay for it, when I pay for it, I make money on the transaction because the Bitcoin or the crypto is worth more. I actually pay taxes. So I would not go as far to say it's valueless in a transaction environment, because as a currency, at this point, it's fiat currency, no different than the US dollar. It's backed by confidence and the ability to exchange it. And so people will accept it as long as they think in the future they'll be able to give it to someone else, or it's going to go up in value, or both. And so there will still be people that come out with it. I think ultimately, from a currency standpoint, to answer Brandon's question on transactions, I think at some point we all will end up using a blockchain-based currency, whether it's going to be Bitcoin or Ethereum or digital US dollars. I don't know which one wins. But I think that that's the direction we're headed. I think that the central banks have a lot of incentive to get us on a paperless system, because at that point, there's a lot of control and lack of privacy that happens with our transactions. So you probably will still see more happening there. companies, stores accepting, cryptocurrencies. Part of it is also PR and popularity. It's a cool thing to do to say you accept it. The reality is, I don't think a lot of people are spending in cryptocurrency, just because, again, if it's going from 30,000 to 60,000, nobody wants to be the guy that bought the pizza with it when it first came out, that says, yeah, I blew potentially millions of dollars worth of cryptocurrency on pizza because I used it as currency. So it's there and it can be used. It's still not in the point where I think it's functional. And I think by the time it gets there, it's going to be heavily regulated, and it's also going to be probably hijacked by central banks in some way, shape, or form. We have a question from Josiah here. Let me bring Josiah on live here. All right, we have Josiah live. How are you tonight, Josiah?
Hey, Jerry. Good. Thanks for taking my question.
Hey, absolutely.
Yeah, so I bought some gold in high school. My dad had me buy some, and at the time, I remember that platinum had like a higher per ounce cost. The cost of it was that. I don't know if the value was higher, but I thought that was interesting what you pointed out with silver having a greater fluctuation. Therefore, it's a less predictable asset to hold. Because it can dip a lot further than gold will. Where would platinum fit in that?
Yeah, so that's a good question. I have not actually looked up the standard deviation on platinum. I would guess, and don't quote me on this, actually do the research yourself. I would guess that platinum is probably less volatile than silver, but more volatile than gold. If you look at platinum pricing, it's definitely one of the more expensive ones. I think the value of it is a lot different because of its use. It's not something central banks buy and collect. And that's one of the things that makes silver more volatile is the central banks don't really own silver. So there's a lot of industrial use. And so silver can follow business cycles. And then there's a lot of trading that happens in silver that can move the prices back and forth. I'm not sure where platinum falls into that, but if I had to guess, I would say that it's probably somewhere in the middle between the other two assets there. All right, we have a question here from Haru. Let me bring Haru on live. Lots of questions today, guys. I love it. All right, so we have Haru here. How are you tonight, Haru?
I'm doing great, Jerry. How are you?
I'm good. I'm good. Did I pronounce your name right?
Yeah, you got that right on point without even trying.
Awesome, man. Awesome. What is your question?
Oh, so basically, I want to know if I own like 18 karat golds or 24 karat gold pieces and like 24 karat gold coins, are they still like feasible as currency? Well, not currency. Well, yeah, I want to know, can I still use them as currency if I trade them in?
Yeah, that's a good question. So anything above, I believe 14 carats, is it 14 or 10 that's deemed pure gold in the jewelry industry? I think it's over 10 carats. So if you're at 18 to 24, 24 is investment grade. So if you have 24 karat jewelry, that means it is 0.999 pure. And it basically is something you could trade in and get spot price for. If it's 18K, you're probably looking at 90% pure. If you get down to like the 10% marker, you're like below 50% purity. So you could definitely trade that in. As far as it being currency, you could definitely barter it. Like you couldn't go buy groceries with it, right? So it's not going to be something you transact and treat as a currency. Definitely is a store of value. It definitely has real money in it, being gold. And you could for sure trade that in and get something for it based on a pretty close to or exactly at spot price. Brad has a pretty interesting question. Let me go ahead and bring Brad back on here. All right, we have Brad back on. Brad, go ahead and ask your question about the Fed.
I thought you'd think this is interesting. What do you think of the Fed Reserve and the U.S. Treasury working so close together now? Jerome Powell and Janet Yellen look like they're merging into one person or one entity, and both of them have been or the current Fed chair. So you've got really, I would think discrepancy or conflict of interest is better word for it.
Yeah. So I don't know what to call that other than sketchy as hell, right? So the Federal Reserve Bank, they're a private organization. They issue our currency. They cannot be audited by the federal government. They cannot be controlled by the federal government. And so they basically are their own free reign arm of finance and currency. And so there used to be so then the Treasury, right? So it's kind of like the US Treasury Secretary is in charge of US finance and policy. There was at least some counter intention between the Treasury Secretary and the Fed. Yeah, like Brad's saying, now they're one and the same. We literally have a former Fed chairman running the US Treasury, and then we have the current Fed chairman running the Fed, and they're basically speaking the same language. What you'll see is if you research these people's backgrounds, they all came from the banking industry. So these are bankers, these are Wall Street fat cats, these are modern monetary theorists. And so if you look at what they're doing right now, they're getting rid of paper currency. They're trying to get rid of Austrian economics. They're trying to get rid of the idea of value. If you look at people today, they can't tell you the difference between price and value. That's by design. So I think a lot of this is a long game that's been in the making, and the final chains have finally come together on the link. And I think it's a very, very interesting time we're going into. And I am just glad that I'm not in the stock market. I'm not in the digital market. I'm just owning physical things that I can control. Because at the end of the day, guys, with gold, and this is the one thing about gold that you cannot say about anything else. It's nobody else's liability. There's no counterparty risk, and you cannot manipulate it. Okay. An ounce of gold is an ounce of gold. It doesn't matter how you denominate it. There's a difference in mathematics between the numerator and the denominator, right? So if you take an ounce of gold and you denominate it in US dollars, sure, a different amount of US dollars fit into 1 ounce of gold than an amount of euros. But that's not the numerator. The numerator is 1 ounce of gold, right? So it doesn't matter what the price is. 1 ounce of gold will always be 1 ounce of gold. And so the idea that there's a tangible firm value that can't be changed or manipulated is not something that the Fed really wants the US public to be in on or own, because at the end of the day, our entire economy is manipulated. So things that are unmanipulatable, if you think about like a river where there's a rock stuck in the middle, it creates rapids. In an economy, that means volatility, it means problems. And so they want to get rid of any of those firm rocks that act as an accountability system, because they just want to be able to flow through with their own deal and not have any resistance. Let's see here. See if there are any other questions here. We've got a crypto nut in the comments here tonight. Andre says they want us to own all physical assets and have no digital assets, or have no physical assets and have us own digital assets. That's exactly it. We're heading into, there's even articles, if you go to the World Economic Forum, there's a real creepy guy named Klaus Schwab, and he's all about how we're never going to own things and we're going to rent it all and be happy, and how the billionaires know what's best for us. And all of this stuff is happening out in front of us right now. All right, I think we answered all of our questions here in the Zoom comments. Let me see if we have any on Facebook. It's interesting how you talk about gold and all of the Bitcoin bugs come out. So a couple of things I want to say on Bitcoin before we close out. And I don't know why gold attracts you guys, but gold and Bitcoin are not the same thing. They're totally different, right? So the idea that Bitcoin is digital gold, if that phrase were true, that means gold is physical Bitcoin, which is not true, which means Bitcoin is not digital gold. They're two different things, right? Bitcoin is a software as a service. It's like a tech stock with no earnings that provides a value increase, and it's not based on anything other than the amount of people that own it. They're totally different assets. So we won't do a course on Bitcoin because it's not something that I believe most people need to be invested in right now. I think, if you want to own it, great. But if you're telling others to own it, like, that is investment advice. So when you're saying invest in Bitcoin, you should buy Doge, you should buy Bitcoin, you should buy Ethereum. Realize you are giving people investment advice. And if you're not licensed and a professional, you should not be doing that, because you hold personal liability. You can go to court and they can try you as an investment advisor because you were performing in the capacity of one, because you were telling people buy Bitcoin. That's the reason why in 2018, Facebook banned it, if you said anything with Bitcoin, they shut your posts off because people were following those posts. So if you want to own it, great. Don't tell other people they should. Like if they want to, great, you can share information. That's awesome. But telling people do this, do that, own this, own that, like there's an inherent risk that goes with that on you and on them. And so that's not something I think most people intend for when they're giving their crypto advice. But as a former financial advisor and a professional, like I care about you enough, even though I don't agree with you, I care about you enough that I don't want to see you in court being tried as an investment advisor because you told someone to invest in Bitcoin and it tanked and then they lost all their money and they said so-and-so told me that I should, and I took their advice. So guys, I think that's all the questions that we have here on Zoom. Let me see if we have any more on Facebook. I think that's it. So guys, I'm going to go ahead and log off. Thank you all so much, and I'll see you next time.